this GHS at COP26 event co-hosted by the City of London Corporation and the Green Finance Institute. My name is Julianna Tatelbaum, and I am a news anchor at CNBC. Over the next hour, we will be discussing the key questions at the center of the debate around how to mobilize private capital in the transition to net zero. And I'm very pleased to be joined by a very impressive and influential group of panelists. So let me introduce who is joining us for the next hour. We have Larry Fink, co-founder, chairman, and chief executive officer at BlackRock. We also have Lord Mayor William Russell. And this event is organized in large part by Mark Carney, United Nations Special Envoy for Climate Action and Finance. We've also got a broader panel, which includes Greg Case, the CEO of Aon, José Viñals, chair of Standard Chartered, the LSE Group CEO David Schwimmer, Alison Rose, CEO of NatWest Group, and Andy Briggs, the CEO of Phoenix. So we're going to break this into two parts, and we're going to kick things off with a fireside chat between Mr. Fink and Lord Mayor William Russell. So if I can open things up, Lord Mayor, by asking you to characterize for us the role finance will play in the transition to net zero and how private capital fits within the wider financial system when it comes to addressing climate change.
Well, I think finance is going to be absolutely critical. And what we're seeing today here is finance leading from the front at COP26, which, according to Lord Stern, is the first time he's seen that, and he's been to every single one of the COPs. But I think it's absolutely critical because without finance, we aren't going to be able to achieve what we need to achieve around climate change. And it's going to be private and public finance together. But I really believe that you'll hear from this COP26 how private finance is going to be leading the way. Mr.
Fink, clearly the public sector can't take the whole burden of funding the transition. Money has to come from the private sector as well. And the emerging markets haven't had the promises made to them come good from the developed world. I'm curious how you think about the sharing of risks between the private and public sector and the role that plays in getting capital into the parts of the world that need it most.
Well, it's very nice to be here in Glasgow. I think it's essential that we come together, both public and private. We just announced today a partnership that we did with the French and German government where they provided the first loss piece, and then we were able to raise way beyond the target of 500 million. We raised $670 million. We could have raised a lot more. And this is a great example of leveraging what public capital can do and leverage it in providing much more. All the money will be going to investing in sustainability in the emerging world. And that is going to be the key project. I also believe that if we are going to really be serious about climate change and climate risk in the emerging world, we're going to have to really focus on the reimagination of the World Bank and the IMF. They don't provide generally first loss piece. They are charter states that they have to have. They are the senior lender. And just not enough private capital is going to be coming into the emerging world today because of the risks associated with the political risks, investing in brownfield investments. And so if we are serious about elevating the amount of capital that's going to the emerging world, and right now it's only about 150 billion, and all the estimates says it's going to have to be about $1 trillion a year for the next 30 years to really move the whole world, including the emerging world, to a more sustainable platform. And so I'm urging the owners of those institutions, the equity owners, and that's all the major countries of the world, to focus on how do we reimagine these institutions and rethink their charter. There is a huge amount of private capital associated behind this if we could find some way of mitigating some of the first loss piece risks there. And so this is something that I have been enthusiastic about, and I believe if we're going to be serious about addressing global climate change, not climate change in one specific country or the role of finance, we are going to have to refocus on how we do this, and we're going to have to change finance, and capital markets have done a great job in doing that. We now need to focus on the emerging world.
Lord Mayor, we'll hand it over to you for this portion of the event.
Well, thank you very much. And Larry, it's a pleasure to be with you.
This is an honor to be on a panel with you, Lord
I
Mayor.
feel the same, actually. I know you've been working with Mark Carney a great deal on GFANZ. Can you talk about that work and why it's so important?
Well, I would say the key issue is, finance drives everything. That's the importance of finance in any society. But also it has to be beyond just finance, or we're not going to get it done. And GFANZ is about focusing on targeted industries and trying to have that moving forward, and working with finance and the industries, with the hydrocarbon industry, trying to move forward, the airline industry. How do we move forward together in a more appropriate long-term way? What I think we are missing in most cases is there is a lot of large talk. There's a lot of big words, but we're not going to get to a climate changed world. We're not going to have this decarbonized world unless we have long-term substantive conversations of the combination of public, private, and in private to be finance, working with every industry together. And we need to have that dialogue, and GFANZ is the beginning of these dialogues of finance working alongside all the various industries that are heavily utilizing hydrocarbons, from agriculture to airlines to industrial manufacturing to constructing of homes to obviously all the hydrocarbon companies today. Let's be clear, the hydrocarbon companies are part of the solution. They're not the problem. And I think if we the one key message that I'm here in Glasgow is about, if we are not working with the hydrocarbon companies together, we will never get to a net zero. If we are not finding ways of mitigating of demand, right now there's so much focus on mitigating supply. And so this is why we're sitting with higher elevated energy prices. And the most important thing, I think, what we're trying to do at GFANZ and everywhere, and I hope the entire COP, we need a fair and just transition. If we're not getting a fair and just transition, we're going to create more polarization in the world, more political uncertainty. And getting back to the first question I was asked about the emerging world will not come along because they can't afford it.
Yeah, absolutely, and it's remarkable what GFANZ has achieved in just 9 months.
A lot of powerful people pushing a lot of powerful people forward. That's pretty important.
Yes, no, exactly. And in your letters, you've called for public companies to make climate-related financial disclosures through TCFD.
Right.
And there's been a huge shift by companies to doing that. And you've also emphasized the importance of private companies doing so. I mean, can you speak about that? Because I've heard you speak about your concern about the private side. You're less concerned about the public side.
I'm very impressed how fast public companies are moving forward. It was just 2 years ago we started asking public companies to move forward and to start reporting, and more public companies are reporting. This is before any regulatory change, and I do believe we're going to see the SEC and more regulatory change within the European group to ask every company to start reporting more. And so I think that's all forthcoming. And so more and more public companies are moving forward and doing this, and they're doing it voluntary. I mean, the large shareholders like BlackRock are asking for this, but the transformation in the public arena is very swift. Once again, if we're serious about a decarbonized world, if we're serious about moving forward, we can't just ask public companies to move forward without the rest of society. It's going to create the biggest capital market arbitrage, and we're seeing that. More hydrocarbons have been sold to private companies in the last 2 years than almost any time ever. That doesn't change the world at all. It actually makes the world even worse because it moves from public disclosed companies to opaque private enterprises. And so the mission is failing if that's all you're doing. So if we don't ask society to move forward, if we don't ask private companies to move forward alongside public companies, we're never going to get to a decarbonized world. We're fooling ourselves. And so I'm not looking for this capital market arbitrage. We're going to make a lot of private entities really wealthy if we create that arbitrage. That arbitrage is existing right now. We got to stop that. But gets back to long-term planning. We need governments to working together, not just doing the window dressing of public companies. Asking public companies because we're all regulated is pretty easy. It's pretty convenient. It's asking all of society to move forward together. And then we're not going to have this polarization between big and small. We already know that society is really polarized right now, and we're going to make it even more polarized if we only ask one set of society to move forward, the large companies, the large public companies, and not asking everyone else to move forward. And so these are my fears. My fears are what we have asked the public companies, and now with high probability of regulatory requests, we're moving public companies much faster than the rest of society, and that's going to lead to a more polarized outcome. Trying to be nice about it.
Very interesting. The other thing is always interested in your thoughts on carbon pricing. It's a big topic at the moment, and it seems something that everyone says, that's the next stage. We need to get to some sort of carbon pricing for the world. We've heard some people say that, if we get to $75 by 2030, then there's a chance of the 1.5 degrees. How do you see that as well?
Well, as I said, we're in a position right now where one or two European countries already just put a cap on energy pricing because politically they can't afford higher energy prices into election. We're seeing the impact of mitigating supply without changing the demand curve. Carbon pricing is a very effective way of changing the demand. But another more effective way beyond carbon pricing is heavy investments in new technologies to bring down the green premium. To me, that is just as critical than a carbon pricing. Carbon pricing has very good outcomes related to demand. A carbon pricing, though, is going to be unfairly distributed in a society. And so any type of carbon pricing must have some form, a way of responding to the the needy who can't afford rising energy prices. Even in Europe today, where there's much higher carbon pricing in Europe than there are in North America, most of that goes to the balancing of a budget. It is not going into the investing and advancing green technologies. It's some of it's going back to a redistribution, but not enough. If we're going to properly do carbon pricing as a world, we need to think about what are the priorities, okay? Should the proceeds of the carbon tax go into all green energy and advancing the technology faster so we could have a breakthrough? We could have a breakthrough in new technologies that bring down the green premium. So, so the curve is not just like this. We have a new breakthrough and it goes up. And that's what we need. And that's, to me, what is necessary. I'm a big believer in the need of a carbon pricing vehicle. At the same time, it is hard to administrate. It's hard to making sure it's fair and just. And you're never going to see that pricing in the global setting with the emerging world. Getting back to the first question again. And so we need to be thoughtful about how we execute it. But there's no question a carbon tax would mitigate demand. And but to me, the other side of the equation is what are we doing with the revenues, and should all the revenues go into the advancement of new technologies rapidly? And we saw how capitalism worked related to, and public-private worked related to a vaccination for COVID. Okay, we have to have the same intensity than we did in COVID, and we're going to have those breakthroughs, but it requires a lot of public investing alongside private investing, and I don't see that happening enough.
Very good. Well, I know you've said the next 1,000 unicorns are all going to be in climate tech, so I'm looking for those unicorns myself.
We are
personally.
Too. Personally?
No, I'm joking.
Okay, good.
Very good.
I will pick it up there. Mr. Fink, I just want to go a little bit deeper into how you think about oil and gas companies. I mean, you've talked about how there is so much focus on the supply side, not enough on the demand side. We've seen oil and gas companies targeted by activist investors with short-term ambitions when they try to focus on sustainability. What do you think is the right approach for companies in these hard-to-abate sectors?
Once again, we need to be thoughtful about the long-term process of how much supply do we need in a decarbonizing world. We need to map out properly how much oil and gas we are going to need so we have a just transition at the same time creating the new technologies. In many cases, new investments, if you have a 40-year break even, they're not going to be good investments. They're going to be stranded. But in the short run, there are going to be many opportunities where you're going to have to do this. If we only focus on public energy companies, on reducing their exploration and R&D, let's step back for a second. The average well is depleted 6% a year. So if there's no investments, their production is down 6% a year on average. And so what we're doing then, shifting more demand. If we don't change the demand curve, it's shifting more of the supply than from Russia to Iran and Saudi Arabia. And that's what's happening right now. The Western hydrocarbon companies of Europe and North America have underinvested because some of the pressure. Some of it's underinvested because oil was too cheap, and it was a bad return for some of them. So it's a combination of both. But we have to ask these questions. If we're going to be still dependent on gas, still dependent on oil for a certain period of time, we need to be thoughtful in talking about that. And we need to be thoughtful about that and how we work with our hydrocarbon companies instead of asking a Gulf country to raise their production. That doesn't change the net zero world at all. It just provides more wealth in a few countries, and it harms our companies. The key for our hydrocarbon companies, they need to rapidly move towards a more decarbonized business model, but at the same time, they are the number one purveyor of energy, of gas and oil, in a society that still is totally dependent on that. And we've solved so many of the issues around electricity already with wind and solar, but we need to be much more thoughtful of how to rapidly build green and blue hydrogen as a great substitute. And we're not seeing enough money being spent there. So our job as a large shareholder of these companies is working with them, not against them. We're not against them exploring as an investor. We're not against them building new capacity, but we want to understand that in their decarbonized path. So it's not black or white. There can be various degrees. If they could show that they could be investing today with a break-even that's very rapid because it's not a costly place to extract hydrocarbons, that will be fine. But we need to also, I've been saying this very loudly too. I don't believe in hydrocarbon companies disposing of their assets, because that goes from public to private. I would like the world to embrace this concept of good bank, bad bank, which I've talked about at a G20 meeting, whereby the hydrocarbon companies spin off a portion of their hydrocarbon businesses into a declining trust. They commit 100% of the proceeds goes into green. So they rapidly expand their green, but they still have the business model of managing their IO stream downward, the hydrocarbons, and it's very public, it's transparent. We need to create these types of vehicles like we've done during financial crisis with banks. We need to create new vehicles, new thought process, not unlike what I said, how we have to reimagine the IMF and the World Bank. We need to reimagine how we could rapidly deploy new capital into the greening of the world in a decarbonized world, but not the avoidance of hydrocarbons in the short run, or we're going to have $120, $140 oil. And that's not a fair and just transition. And that's what we're witnessing right now. And as I said, if you're really truly trying to get a green transition, why politically do you put caps on energy and heating into a winter? It tells you the political realities, how to navigate this. It's not binary, it's very granular. And we have to be thoughtful about how do we take finance, and this is what GFANS is about, how do we take finance, all the ideas that we have in finance all the years, whether it's a good bank, bad bank, senior subordinated, how do we take those different processes, those different ways of financing, and apply that to a decarbonizing world?
Where does the onus of responsibility lie to drive those initiatives that you just talked about, reimagining the way finance flows? It feels as though right now finance is actually getting ahead of regulators, getting ahead of governments. But does there need to be guidance coming from the top?
This would be more accelerated if we had more multilateralism like this COP today, more conversations of doing it together. You framed it correctly. In many cases, the private sector is moving more rapidly. Let me say public companies of the private sector are moving more rapidly than parts of society, and it's leading to more polarization. More polarization. Some parts of America believe we shouldn't be, we should be drilling more. Some parts of America believes we should be greening more. The reality is, the pathway is not going to be from brown to green. The pathway is going to be from dark brown to medium brown to light brown to very lightest shades of green to medium green to green. It is a process, and that requires planning, or we're going to have this imbalance and this unfairness. If we want to create a platform, we have to be thoughtful about how we move forward by not the abandonment, not the underinvestment, if it makes sense in the short run, but to be thoughtful about how can we mix the use of hydrocarbons. For example, we should be rapidly moving away from coal in the emerging world, maybe in the short run to natural gas. I mean, we have to find different ways of mitigation of CO2s, and as I said, it's not going to be from brown to green. There's going to have to be intermediate ways of getting there without creating a real major economic burden on the emerging world.
Well, thank you so much to you both for this opening conversation. Plenty of food for thought as I open it up to our wider panel now. So let me put the first question to José. Thank you for joining us. What is your take on the question of how we can mobilize investment into emerging and developing economies, picking up where Larry left off?
Well, thank you very much. And I think that Larry already said very important things. And I think that there is a need to really mobilize very, very substantial amounts of capital. And the problem is that during the pandemic, what we have had is to increase the sustainable capital gap between advanced economies on the one hand and emerging markets and developing economies. So the situation has gone from bad to worse, and we need to redress the situation very quickly. And I think that the key has to do with the collaboration between the private and the public sector. And just to put a name to what Larry was talking about, which I think is the key, is blended finance. And we need to think of how can we rethink the role of multilaterals so that they can crowd in a much, much bigger amount of private money than they have. So I think that's critical. And there are innovative financial solutions, like creating platforms that ideally could help the multilaterals to co-invest with institutional investors. And there are now attempts in place to develop the frameworks which, from the financial and the legal point of view, provide the right incentives for the multilaterals to invest so that they can lend in line with their mandates without jeopardizing the rating, while at the same time providing adequate risk-adjusted returns to investors. This is something we're working on, for example, through the United Nations Alliance of Global Investors for Sustainable Development, which a number of institutions here are members of, and I think it's very, very critical. Another thing which is very important is make sure that there is transparency in terms of information. I think that investors need to understand better what is the pipeline of sustainable projects which exist. Again, there are initiatives in terms of investor platforms which are making this possible in terms of correcting this asymmetry of information and having supply and demand much, much better. But I think there is also a very important thing. I think that in emerging markets and developing economies, they have to play their part as well in several respects. One is identifying what are sustainable projects. I think it's very important that there is this identification. This may require technical assistance. Multilaterals can also help countries in providing the technical know-how which is needed to identify sustainable projects. And then those projects need to be made bankable. And again, that requires collaboration between the private sector, private financial institutions, global banks like Standard Chartered and others, with multilaterals to identify the risk, the projects, and make them bankable. And again, that's blended finance. So I come back to where I started. And governance. When you ask international investors, why don't you invest in this or that project? Many of them say, well, I have concerns about the governance of these projects, sustainable projects. So I think that emerging markets and developing economies still need to do a lot in a number of cases to enhance their institutions, the governance, so that this removes another layer of discomfort for international investors. But I think that the solution is within reach. I think that the private sector is moving. There is a clear, conscious of not just the moral imperative, but the commercial opportunities which are behind, that capital shift to emerging markets and developing economies to promote sustainable development and to fight climate change in particular. And I hope and expect that we will be able to provide the solutions with the right amounts of capital at pace and at scale.
It does feel like walking around the summit over the last couple of days that the conversation is changing away from talking about climate change as a cost burden and toward thinking about it like an opportunity. Alison, I want to come to you. It feels as though, based on all these conversations with institutional investors and corporate leaders, that the money is there. But how do we actually get that money into the economy and get it working to fuel the transition? What are the sort of practical barriers that you think are important to highlight?
Yeah, and I think the really important point you make there is the money is there. I mean, the work of GFANZ, you've seen incredible collaboration and coming together across the whole finance sector, asset managers and insurance sectors and banks, and there is a huge amount of money and commitment to fund and finance this transition. We are getting ahead of the public sector. What we need are really clear signals from government and policymakers to accelerate the deployment of that capital, and I think that's the really important point. We're actually getting on and doing it and funding the transition. But in the way we've talked about as well, this is going to be a transition, and one thing that is front of mind is making sure it is a just transition. And there is real opportunity here in closing that gap and making sure that we can close the green premium and make it affordable so that low carbon projects are being financed is really critical. One of the things that we've been focused on at NatWest is thinking about SMEs. They're a critical part of the global economy. In the UK, for example, they represent 50% of the revenue, 60% of the employees, and 30% of the emissions. So they have a really vital role to play in getting to net zero. And when you look at the opportunities in front of them, when I look at the projects and the research that we've done, there's 160 billion revenue opportunities. So if you're a business owner, the money is there, the opportunity is there. What we need to do is move into practical steps, really practical help, putting in the hands of small businesses, of private companies, the tools, the access to capital to finance these sustainable projects so that we can transition. Because the last thing we want as we come out of this huge amount of money, real focus is that we end up with a dislocation in developed economies, developing economies, in parts of society who cannot afford or can make the differential or understanding between what 1.5 degrees means and what I can do as an individual business owner. So I think very simply the money is there. There's real collaboration across the finance sector. We need clear signals from government and policy owners, and we need to close the gap in pricing and put practical steps in the hands of the people who are going to make this change.
David, I see you nodding along, so let me come to you next. What difference would having international sustainability standards make?
So what we're talking about here is a massive change in terms of how investors allocate capital. And it's a huge transformation. We've had a global economy that's been reliant on fossil fuels for 200 plus years. We're trying to change this over the course of the next 10, 20 years. So dramatic transformation. The question is, how do you do that? How do investors have access to the data and the information, the analysis to make that kind of transition in a smart way and in a way that's effective. And then if you look at it from the issuer side, how do you, as a company that's looking to address your own needs and attract capital, how do you figure out how to disclose or provide the right information that's going to attract that capital? So the global economy has to go through this massive transition, and we need a new architecture. We need a new playbook. We need new rules as to how to do it. And we've made terrific progress in this area in a number of ways. TCFD is a great framework for disclosure in terms of companies using that framework, and it's a start in terms of providing information on how climate change, how climate risk affects your strategy, how do you manage the risks associated with it, what are the metrics you use, and then of course how do you govern associated with it, what kind of governance you have. But it's only a start. And so to your question, what the IFRS Foundation is doing and the International Financial Sustainability Board, this is a real opportunity to create a new rule set in the same way that we have accounting standards, to have new standards, new rules for companies to address their climate issues and their climate risks, and then for investors to look at that data and use that in terms of making their investment decisions. So one part of the puzzle. There's more to do. I think we're also making good progress in terms of taxonomies, which are really important in terms of having comparable data on a global basis. If there's an auto company in China that's using steel and an auto company in Germany that's using steel, how do you evaluate the greenness of that steel in each of those manufacturers? The good news is that the different markets around the world, different countries and their regulators are talking about aligning these taxonomies. And I think to the extent we can go down this path with the Sustainability Board and the associated standards there, with taxonomies that are aligned on a global basis, we can make real progress in this area.
Andy, let me come to you. The insurance, long-term savings industry can play obviously a major role in tackling climate change through the choices you make around your long-term investments. But how do you ensure that the actions that you take will actually create the change you want to see in the real economy?
Yeah, so going back to your previous point, Julianna, I absolutely see this as an opportunity. We've worked out that it will cost about £2.7 trillion over the next 15 years to achieve the UK's net zero goal. The long-term savings and retirement sector can fund about a third of that, about £0.9 trillion or 60 billion a year. We're doing a fair amount at the moment, but nothing like at that level. So the first thing I'd say is all of us as asset owners, we need to think about doing three things. Firstly, we need to set really clear targets that we're held accountable to, and I think the clarity disclosures around that and consistency of that is key. So at Phoenix Group, we're the UK's largest long-term savings and retirement business. We invest £300 billion on behalf of 13 million customers. So we've committed, obviously, to net zero by 2050 for all that 300 billion. We've then taken the 250 billion of that where we have a mandate. We have a mandate from our customers. We've committed to halve the carbon emissions from that by 2030. That's equivalent to the carbon output of a quarter of the homes, so 6 million homes in the UK. So that gives you a sense of the scale of difference we can make. And then we've also committed that the 160 billion of that 250 billion that is listed equity and debt, that we will reduce that by 25% by 2025. Because I guess as a CEO committing to 2050, I doubt I'll still be doing the job at 2050. I quite enjoy it, but 2025, 2030, quite possibly. And I'm held to account against those targets. So that's the first step. Second step is then to systematically go through the investment portfolios, to look to weight them and tilt them towards greener investments, to look to take a very active stewardship role, as Larry was saying, with the companies we invest in. I'm not a believer in just exclusions from the get-go at all. I think we need to work with companies to bring about a transition, and as a result, invest significantly more. And then thirdly, I'd say from a customer perspective, I think it's really important we engage our customers on this. We did the 300 billion we invest is on behalf, for our 13 million customers. As we talk to them, 85% of them expect that we are investing that money sustainably for them, even if the fund doesn't have a sustainability label on it. So I think there's more we can do to leverage that and leverage the demand side.
Larry, I just want to come back to you, and I want to get out to Greg in just a moment, but picking up on Andy's point, he seems to echo your thoughts about how it's not about exclusion, it's not about drawing hard lines around the companies that you're willing to invest in, but you're here, at COP26, there are protesters outside protesting what's happening inside. BlackRock has also faced criticism from both the left and the right on your own ESG strategy. So how do you communicate with not only your own shareholders, but the public about what you're doing and that it is the right approach?
Well, you're right. We are being attacked from the far left and the far right. And yet our voice with our investors has never been louder. And our growth has confirmed that connections that we're having with more clients worldwide than ever before. We have to remind both the left and the right, and we have to remind everybody, this is not our money. 100% of the money that we manage is on behalf of asset owners. So our job is to give them the knowledge of choice. We are developing many, many sustainable strategies. We actually have raised about $400 billion in sustainable strategies. We estimate there's $4 trillion of money that has moved into sustainability. So we represent about 10% of that strategy already. But it is up to the investors to determine where they want to place their money. If they want to be in a regular liability, an S&P or a MSCI or any liability, it is their choice. Now, what we're trying to show them through data and analytics that we're investing in, why we believe in the long term investing in more sustainable indexes and liabilities, investing in these type of strategies, will be the proper fiduciary strategy. So everything we are doing is in the minds of our asset owners, and our job is to rapidly educate them and have moving forward. And so I don't believe there's any other firm doing as much as we are in finance. And that's why we have the far right pushing us, because they think we're doing too much. And I do understand the far left's views too, that time is running out, and yet it is not we're a fiduciary to the owners of capital, and our job is to try to educate them and move that, and we are rapidly doing that and building that. But it's not going to happen overnight, and it's their decision. We are also working with the index players and saying, okay, how can you create better indexes, better liabilities? So more and more of the asset owners saying, I want to be in that index, or I want to be based on that. All of this takes time. But if we only focus on a BlackRock with our holdings of public companies, and we don't focus on the private sector, we are going to see the largest capital market arbitrage in our lifetimes, and it's beginning with, a U.S.-based newspaper identified that there's more movement away from hydrocarbon assets into private hands than any time ever. That is not changing the net zero world. That's window dressing. That's greenwashing. And so we need a much better holistic solution of trying to navigate all this. We're doing our part. I think we're doing our part as well as anybody, if not better than anybody. And we are going to continue, and this is my pledge to everybody, that we're going to be moving people forward. But I can't, if I'm going to be a fiduciary, which I commit to everybody, every moment that we have to work with our owners of the capital to move them forward.
Larry, thank you for your take on that. Let me bring in Greg now, who's been waiting patiently. Greg, I'm keen to talk about how climate change is influencing your business. Climate change, increasingly extreme weather events have caused a surge in natural disasters. How is that impacting your business, the insurance industry more broadly, and how well do you think that the insurance industry can price climate risk?
Well, Julianna, a pleasure to listen to the panel, Lord Mayor, Larry, and everyone. I think what you're hearing across the board is the idea of momentum, opportunity, and a new standard on public-private. Absolutely has to happen across the globe. It can't be one sector, one aspect. It's got to be the entire marketplace. And I think that to answer your question, Julianna, you have to start a little bit with the situation. We think about climate change, we've thought about it from a distance. It's no longer there. It's at our doorstep. And it's causing a level of economic volatility, which is beyond unprecedented. You think about since the turn of the century, 6,200 discrete events have caused close to $5 trillion plus in economic loss. A fraction of that, a little over $1 trillion is insured, and that gap is really only growing. And you asked about insurance. From an insurance industry standpoint, I'll tell you, in our 300 years, that level of economic volatility has never existed before. So you think about it, even last year alone, it's $270 billion plus, and only a fraction again is insured. And so from that standpoint, and reflecting on where the panel has been, you really do have to identify, we're talking about not just one issue here. This just isn't climate on one front. This is, at least two the panel has highlighted. Of course, we're talking about what types of steps do you take to mitigate risk, to reinforce action to get to zero carbon. Without that energy, the movement Larry's describing just doesn't happen. We've got to focus on that new investment. But the facts I just gave you suggest we've got a serious resilience and volatility issue that's in the here and now. When you think about the developing countries, that level of economic volatility is real, and we've got to address it. And we got to address both. It's both the future investment as well as the resilience in the here and now. And as the panel has highlighted, this is a government issue, this is a private issue, this is a new standard, and really public-private as it works together. And if we must create the conditions that draw capital in, or we can't really grease the skids. The momentum we've alluded to doesn't pick up. And last point I want to make, Julianna, is with data, analytics, content, insight, we have proven the concept. We can do this. This is not conceptual. We've matched capital with risk in countries like Mexico, Peru, Chile, Colombia, Jamaica. We've helped them recover from earthquakes and floods in ways they never could have before, bringing in private capital. That means the investment was not just coming in, it was coming in a way in which, when a school's rebuilt or roads rebuilt, it's done in a way that it's climate resilient. And so what I think you're hearing from the panel, this idea of momentum is proven. We can do this, but we don't have nearly enough, not even scratching the surface and bringing in the level of momentum we need to accomplish what the panel and we're talking about here. But it's really on both fronts, both on the future investment as well as on how the here and now and the resilience we've got to address in the developing countries. But we can do it, and we've proven we've made progress in it.
Jose, let me come back to you and ask about Article 6 negotiations, which are one of the key focal points of the COP26 summit. And how would agreement on carbon pricing, you think, affect capital markets behavior and activity?
Well, Larry has already talked about carbon pricing. I think that the underlying logic, of course, is this is something that should correct a fundamental externality that we have and provide the right behavioral incentives for much needed adaptation. Then there is the subsequent issue of whether this falls on supply or falls on demand, and ultimately how this is reflected into prices and quantities. But I think that the private sector can also make a contribution on the carbon pricing. And I just want to bring up here the task force on scaling voluntary carbon markets that Mark Carney launched, and that is actually chaired by my CEO, Bill Winters. And by establishing a market where carbon credits can be traded, carbon credits of quality, in a deep and liquid markets, through the price discovery process, you're going to arrive at market prices for carbon credits, which I think are going to be very important, again, in aligning the right behavioral incentives of companies. So I think this is very, very critical. But for those markets which are no substitute for the reduction of emissions which are needed, but a financial complement to those, if those markets are to scale up, you need to have some recognition for the companies which are using these carbon credits in their net zero transitions, recognition which is not granted now. So I think that serious consideration should be given to that, as I said, as a complement, not as a substitute for cutting sort of emissions. And that is also something which is going to allow a lot of money to flow into climate positive and nature positive projects relating to carbon credits. And again, this is going to be a vehicle for the transfer of resources from advanced economies to emerging markets and developing economies, which I think would be very important for the world, because these emerging markets and developing economies are natural producers of whatever can be behind these carbon credits. So I think that that would be a win-win, and we should seriously think about that.
Alison, what do you think would be the most important thing that policymakers, regulators could do to unlock private capital and get it flowing to the parts of the economy, the parts of the world that need it?
Well, in a large part, we've talked about the fact we know that the money is there, and getting it flowing is really important. And I think one of the things that GFANZ has done is has put together a playbook, a global playbook in terms of what is needed, which will give, integrity of, it ensures integrity, it sets out best practices, and it creates that transparency and ambition. And I think, an important part, there are 5 aspects of that, but, having clear targets, the net zero targets, clear ways of getting the money to the developing economies, so real incentives in place as well, and making sure that the regulatory architecture, we talked a little bit, David talked about, the taxonomy that is so difficult and misaligned, but getting that sort of regulatory architecture in place is really key. And so I think, that global playbook and best practices are clear ways of doing that. And I think there are some very, very simple things that we can do. One of the things that we've been working on, and David and I have been working on as part of the GFANZ group, is how do you decarbonize sectors, and set out really clear best practice so that, companies have a very clear idea of what a credible transition plan is. So they're committed to the net zero target, but this would be a credible transition plan that finance would understand and recognize and would unlock, and that will make the money flow. So I think sort of the work of GFANZ has shown the money is there. There's real collaboration. There's a series of targets and best practice, and that, I think, is very simply how we will unlock the finance and make sure it's flowing into the developing world, as well as a consistency and integrity. And I think that will really drive the ambition to go forward.
Well, absolutely.
So I can completely agree. And so 2 specifics I would say we're looking for from government and policymakers. One is exactly that point about this end-to-end sort of stable market environment. In the UK, we've made fantastic progress on offshore wind. The cost has gone down from £150 per megawatt hour down to £40. There's substantial capital flowing. So we've got examples where this works, but we're not going to end up decarbonising the UK housing stock by a provider like ourselves going to individual householders and offering to lend the money to do it. It needs some coordination around it. And then the second element is regulatory change. The current insurance Solvency II capital regime basically is based on lots of historical data, and it's a very long lead time to get anything agreed. So it's far easier for us to invest in a coal mine than a wind farm, and that cannot be right. We've got to change that so we can have a much more real-time perspective look forward at how we can invest, because if we don't know the capital treatment of an investment, we can't make the investment. So those are the 2 specifics I would draw out.
You need that clarity. Excellent practical example. I'm conscious of time, and I want to just bring it back to Larry to wrap things up. Larry, you made the comment that time is running out, and you, as the head of the world's largest asset manager, it can't all fall on the shoulders of asset managers. What do you hope is achieved over the next 2 weeks here in Glasgow?
Well, it can. It won't work, but it can. We have to be open-minded about what it's going to take. We're going to have to be brutally honest about beyond just the window dressing of big commitments. We need to be focused on how to build a plan with granularity and continuity beyond these 2 weeks, and have a platform of plans of having the public-private world working together to come up with solutions. It is going to require an enormous amount of investing in the emerging world. It is going to require an enormous amount of public and private investing in new technologies. To get to a decarbonized world that is fair and just, it is going to require some incredible breakthroughs in technology that we don't have yet. And we have to admit that, and so let's dedicate a lot of quite a bit of attention to the investing in, so we could rapidly get to green hydrogen, that we could change the footprint of agriculture, that we as consumers, we all change our preferences and patterns, that we do things differently. We can get there. If the world wants to get there. We've proven it in a rapid discovery of a COVID vaccination. Capitalism works, and capitalism works with good public policy. And hopefully we use just the most recent example where public policy and capitalism works. Let's do it again, but let's do it even bigger.
All right, well, an excellent note to end on. A huge thank you to all of you for your time today. I will just run through who we've just been joined by. Larry Fink, of course, Lord Mayor. We've also got José Viñals, Greg Case, Alison Rose, Andy Briggs, and David Schwimmer. So a huge thank you to all of you. And a thank you from me, Julianna Tatelbaum at CNBC. This has been a GHS at COP26 event, and we will see you around soon.